What kind of mortgage should I get? If you're in the market for a new mortgage, you're probably wondering, what kind of mortgage should I get? This video will go over AMRs, FHA loans, USDA subsidized loans, and USDA subsidized loan. Learn how each one compares and which one might be the best for your situation. Then decide for yourself or consult multiple lenders. For those with lower credit scores, FHA loans are a great option. Fixed mortgage. A fixed mortgage rate is the most popular type of home loan in the United States. A fixed mortgage means the interest rate will stay the same the entire loan term. This makes budgeting easier since the monthly payment will remain the same. It also offers a more predictable payment schedule. Fixed rate mortgages can have lower interest rates, which are adjustable rates for mortgages. But there's always a chance that this will increase payments and rates. For borrowers who have perfect credit, a conventional loan may be the right choice. These loans require a credit score of at least 620 and a debt-to-income ratio no more than 43%. Many banks and credit unions offer these loans, but you can find them online. Make sure to check your credit score and your personal financial information before deciding on a fixed-rate mortgage. If you're unsure whether a fixed-rate mortgage is right for you, contact a mortgage loan officer about your various options. Another benefit of a fixed mortgage is stability. Although adjustable rate mortgages can be more expensive over time, their monthly payment will stay the same. The stability allows homeowners to plan their finances and better make more informed decisions. As long as they make their mortgage payments on time, the interest rate stays low. This makes fixed rate mortgages more affordable options for many consumers. You can lock in low interest rates for up to 30 years. The fixed rate mortgage is the most stable mortgage option. Your payments will remain the same for the life of the loan, and you will never change. It's a popular option for long-term home buyers and is less prone to surprise increases in interest rates. You can also use fixed-rate mortgages if you want to refinance your current mortgage situation. For example, 15-year conventional fixed mortgage is especially popular for those who plan to keep their homes for a long time. ARM, adjustable rate mortgage. ARM is a type of loan that starts with a fixed rate for an initial period of time, and usually about 5 years, the interest rate can increase significantly during the period of making it an unaffordable rate. A fixed rate mortgage, on the other hand, has a fixed payments throughout the life. In addition, the ARM requires a higher down payment than the conventional loan, which requires only 3% of the purchase price. Most ARMs have caps or floors that limit the interest rate and increase the monthly payment increases. These caps affect four main types of RAMs: initial adjustment, subsequent adjustment, and lifetime cap. Initial adjustment caps limit the interest rates increase for the first time, and while subsequent caps limit increases after initial adjustment. In some cases, these caps carry over, make it impossible to apply for an index rate increase, and the increase can be carried over a subsequent adjustment period. If you do this, the overall interest rate of the loan will increase. Adjustable rate mortgage. ARM has a fixed interest rate for an introductory period, which may be 3, 5, or even 10 years. After this period, the ARM adjusts to the market, which may be lower or higher than the initial interest rates. The rates changes periodically, usually once a year, and the homeowner's payment increases and or decreases depending on the interest rate and the market's volatility. The 5-to-1 ARM, for example, guarantees the same interest rate for 5 years before switching to a variable rate for the rest of the life of the loan. The initial fixed rate is usually lower than the corresponding fixed mortgage, making 5-to-1 ARM a desirable option for a homeowner. However, ARMs are subject to interest rate caps that determine the maximum amount a homeowner can increase or decrease their monthly payments. USDA subsidized loans, which help to qualify for a USDA subsidized loan, you must have a stable income and meet the qualifications. The maximum ratio is 29 to 41% of gross income, and your house payment and debt payments cannot exceed those percentages. You may qualify for this loan with a credit score of 640 or higher. If your credit score is lower, you can still qualify with this loan with a program that has a non-traditional credit references such as utility payments history. The USDA lending guidelines vary depending on your area, and you must meet them before applying. In expensive markets, your monthly mortgage payments cannot exceed 29% of your gross income. The income limits for a USDA loan vary based on your income and assets. You must have a debt-to-income ratio of less than 50%. You can apply for a loan with a maximum of $325,000, but you cannot exceed the maximum loan amount in your area. If you want to apply for a USDA loan, you must also plan to live in a property as your primary residence. You must not have other housing lined up or an option to take out a second loan if you lose your job. USDA loan also allows you to use the gift of money to closing costs. With this loan, you can borrow up to the appraised value of your home and use any existing money to pay the closing costs. However, you must prove that your income and asset ratios are not too high to qualify for a conventional mortgage. As of December 2014, the USDA has not updated the debt ratio policy. You may want to consider applying for this loan if you have substantial gift from family members or friends in the terms of monetary. The Assumable loan and Assumable loan for mortgage is an attractive feature for buyers looking to buy a home with less equity. If you have a lower interest rate, which might mean lower monthly payments or lower total cost of borrowing, assuming the mortgage can come with extra fees. The seller must ensure that they receive a release of liability from the mortgage holder to avoid owning and remaining balance, which can put them in a bind if payments are not made on time. Before closing on a sale, the buyer must sign the closing paperwork to release the original borrower from the mortgage debt. This document will also confirm that the seller is not responsible for the mortgage. In some situations, an assumable loan will require the seller to sign and release a liability. In these cases, the seller must consult with a real estate attorney to discuss the details of the assumption loan. When the buyer signs the assumption paperwork, he must ensure that the existing mortgage lender approves the transaction. The borrower must also get approval from the lender before the process of assumption loan. In case of rejection, the lender may demand the entire loan immediately, making the seller responsible for paying the debt. However, assuming the mortgage will affect the borrower's credit score more than obtaining a new mortgage. In addition to the approval of the lender, assuming the loan officer will require a borrower to provide a credit report, income, employment, and other details to confirm their financial status. Unlike new loans, assumable loans require the borrower to prove they are creditworthy. This means the servicer will perform a credit check, verify the buyer's income and assets, whether they make their payments, and other features. Assumable mortgages are not available for conventional loans, but some non-consuming units are eligible for loans. When a buyer decides to purchase a property, the buyer must contact the seller's loan servicer so they can ensure they can afford the mortgage. Government-issued loan. When it comes to home loans, you probably heard of FSH or USDA and government-issued mortgage programs. These mortgages are a great option for home buyers because they require smaller down payments and have a wider range of eligibility requirements than traditional loans. But these programs, are they right for you? We're going to find out as we talk about it in this video and the differences between a conventional loan and a government-issued mortgage, and give you a clear idea about the benefits and disadvantages. If your credit history is less than perfect, a government-issued mortgage could be a great option for you. These loans allow you to purchase a home even with bad credit history, which make for a conventional loan, it could be difficult to obtain. With an FHA loan, you can finance the entire mortgage for as little as 3.5 down payment. But the VA loan has no official credit score minimum, but most lenders require at least a 620. USDA loan generally requires 640 and has income limits based on the area you're buying property in. With the FHA loan, the most common government-issued mortgage, there are many offers. FHA loans are issued by the federal government and are often easier to qualify than conventional mortgages. The FHA program is backed by the HUD and the Federal Housing Administration. Because FHAs are backed by government, they're safer for the borrowers than conventional mortgages. For this reason, mortgages are popular with this amongst many people. One of the biggest advantages of government-issued mortgage is the competitive interest rate. You'll be able to qualify for competitive interest rates because lenders can offer you government insurance. Keep in mind that this type of mortgage is not suitable for everyone. For those with low limited savings, government-issued mortgages are a great option. However, you should seek professional advice before deciding on a government-issued mortgage. Choosing between different types of mortgages. Having trouble choosing the right type of mortgage? We've got some answers for you. Let's talk about some of these and these interest-related mortgages, jumbo mortgages, fixed-rate mortgages, and ARMs. Each one has different pros and cons. To help you decide, we compiled a brief overview of the different types of mortgage and why it's best for just one mortgage company. Dave Ramsey recommends that you choose one that offers exceptional customer service. So let's get started. Interest-only mortgages, while interest-only mortgages benefit, they're not suitable for everyone. Getting a loan with this type of arrangement is not advisable for many reasons. If you currently have a mortgage and are nearing the end of your term, you're unlikely to qualify for an interest-only mortgage. Many people who are improving their end of term have already hit the age of 50. In addition, people who are planning on retiring due to their mortgage tenure will not meet the affordability criteria. If you are purchasing a new home with an interest-only mortgage, you may want to pay off the entire loan amount early in order to maximize your equity and keep your options open for refinancing. However, if housing prices drop, you may find yourself underwater in your interest-only mortgage. You should consider all the risks associated with an interest-only mortgage before making a final decision. However, if you're confident in your financial situation and are willing to pay a higher interest rate, an interest-only mortgage is a good option. An interest-only mortgage has some advantages. First, it will reduce your monthly mortgage payments. Second, you won't have to repay the principal amount. It will help you improve your cash flow and reduce your monthly payments. Interest-only mortgages are usually adjustable rate mortgages with a term of 10 years. In addition to reducing the principal, they require that you have a repayment vehicle, like, for example, something that can really help you out with paying off the mortgage. So you want to keep in mind all your options when it comes to repayment vehicles. Something like an endowment policy. While interest-only mortgages are popular, they're not the only thing that you should keep in mind when it comes to mortgages. So let's go ahead and discuss some of this. Some of these benefits are not suitable for everyone. Though they are available in certain situations, you need to shop around before making your decision. If you have a high credit score, you should check with more than one lender to make sure you're getting the best deal possible. Remember, interest-only mortgages are a specialty product and may not be refinanced as soon as you like. Jumbo mortgages. The credit score is a major factor when applying for a jumbo mortgage. This numerical rating of your reliability is a function of several factors, and your score varying from 300 to 850. The minimum credit score depends on the type of property and the amount of down payment you want to get, 20% of a deal or more, or even less. Despite these considerations, a jumbo loan is a great option for buyers with excellent credit and large reserves. Although the jumbo market has been thriving for many years, recent economic uncertainty has diminished interest in the secondary market. With unemployment claims at record levels, it is difficult to depict whether the loan will be paid back, resulting in fewer investors interested in buying jumbo mortgages. With fewer investors purchasing jumbo mortgages, lenders are left to retain the risk. The mortgage market will remain at the same or shrink. It really is up to debate in the next few years. The maximum loan amount for a jumbo mortgage is higher, and conforming loan limits set by the Federal Housing Assistance Agency, FHFA. This is because jumbo mortgages aren't guaranteed or insured by the government. The government uses two businesses to purchase jumbo mortgages. Government's involvement in the process makes them less risky. However, it's important to understand that every jumbo mortgage lender has its own standards. The jumbo loan has specific underwriting guidelines and requirements. The maximum loan amount is $400,000, $17,000 for a single-family home in most states. In some areas, such as the nation's capital, it's possible to borrow up to $625,500. Jumbo mortgage can be used for primary residences, vacant homes, investment properties, and vacation homes. And if you have plans to refinance in the future, jumbo mortgages are an excellent option. Fixed-rate mortgages. A fixed-rate mortgage is a good option if you'd like to pay off your principal early without incurring penalty. Most fixed-rate loans don't charge a prepayment penalty, which makes them an excellent option for homeowners who expect interest rates to increase in the future. However, a fixed-rate mortgage interest rate may be higher than that of an adjustable rate loan or interest-only loan. Moreover, borrowers prefer this type of mortgage because they can budget their monthly payments without worrying about rising interest rates. The fixed-rate payment also protects them from unexpected increases in their monthly mortgage payments. Unlike the adjustable rate loan, which may increase your payment after the introductory period is over. Since the interest rate of a fixed loan mortgage is always fixed, it's easy to understand and compare various lenders. Fixed rate mortgages are a smart choice for first-time home buyers, and they are easy to understand and have predictable payments. Fixed rate mortgages come in many varieties. Typically, they are either government issued or private loans. The government-backed loans may be FHA or USDA insured. Residential loans can be categorized as conforming or non-conforming, according to the federal guidelines. Non-conforming loans are loans that exceed conforming loan limits, making them uncomfortable. The difference between conforming loans and non-conforming loans is the loan term. While ARMs are more flexible, fixed-rate mortgages provide more predictability. For borrowers who want to manage their finances and budget, the consistency of an interest rate will be beneficial. By keeping the same interest rate throughout the term of the loan, fixed-rate mortgages help them manage their finances. They also keep monthly payments consistent, which make them easier to plan a budget. The mortgage rate will not increase, but borrowers can relax and enjoy fixed-rate mortgage. ARMs. ARMs are different from fixed-rate mortgages that in their interest rates, they adjust at regular intervals. Since interest rates can increase significantly from time to time, the payments can go up as well. While this can be a problem, there are ways to protect yourself from higher payments. ARMs come with different introductory periods and adjustment periods, and it's wise to check all details before committing to any mortgage. So I hope this video has been helpful. Please like, subscribe, hit the notification bell, leave a comment if you have any extra questions, and we will be back with more information on personal finance and mortgages.